Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello, listeners, and welcome to Business Line's SOE podcast on personal finance for this month. In this episode, we have with us Mr. Abhijit Roy, who's an alumnus of IIT Kharagpur and IIM Kolkata. He's the CEO and co-founder of GoldenPi, which is an online bond platform promoted by Zerodha. In fact, it's one of the largest bond aggregators in India right now. As you know, today there are a variety of attractive investing opportunities, not just in the stock markets, but in the bond markets too, because there has been a sharp rise in interest rates, and both at the short term and longer ends, actually, there are attractive investing opportunities. I am Aarati Krishnan. I'm a consulting editor with Business Line, and I'll be chatting with Mr. Roy on these opportunities and the outlook for interest rates. So thank you, Mr. Roy, for joining us. If we can start out with the rate outlook first. Now, there's a practical consensus in the market that the MPC will be on a rate pause for some time, and it has repeatedly indicated this too. But when can we expect this rate cuts to start coming in? I think that's a question of great interest both to debt mutual fund investors and to bond investors.
Firstly, Aarti, thank you so much for having me for this discussion, and hello to all your listeners for this podcast. Coming to the question, the repo rate cuts are something which I believe we will start seeing a couple of quarters down the line, because more or less the situation has stabilized on the inflation front, right? So we were looking at an inflation control band of plus 4% plus minus 2%. On the higher side, we have been able to see the inflation under control with respect to the rate hikes which were done by RBI some time back, right? The series of rate hikes, and that has given the result. So understandably, now that we see the inflation has come under control, which means RBI is now keeping a watch, and continue stance, as in they would preserve these levels of repo rates for now. But as you know, in order to boost the economy, the cost of borrowing for the industry needs to come down, which means the repo rates needs to come down. So, I think in a couple of quarters, we'll start seeing the repo rate cuts gradually stepping in.
But recently, basically, on the inflation front, we've seen that the Kharif and Rabi both have not been so great because of a slightly erratic monsoon. So this patches of food inflation still seem to be a policy worry, right? And it's an election year also. So do you think the cuts can come in really in a couple of quarters?
I would hope so still, because the prediction of the economists and also of entities who are looking at the Indian market, right, from the global markets perspective, is that the economy is more or less in a stable shape. Number one. Number two, our economy is faring better with respect to the growth, right? Projected around 7.2% growth, right? Vis-a-vis that of China, which was a favored destination for the global investors till some time back. But now, because of a change of a lot of geopolitical equations, right, India has become a more favored destination, right? And given that, the whole perspective continues to be that we are more or less in a stabilized environment, right? Government, I foresee that will not be in a hurry to disturb that equilibrium right away, right? Probably we will see the election getting over, and we have the election just around the corner. So maybe by September or October, we might see certain indications of rate cuts coming in from RBI. Yeah.
Right. So Indian bond market watchers today watch US yields more than Indian yields sometimes. And so we have seen US 2-year come off from 5% or to 4.3 or something currently. So will that also provide a trigger for Indian rate cuts, or is it an irrelevant thing? What do you see?
No, it's very relevant. See, one thing which becomes very important for global investors and also of the US, funds, right, is basically to look for attractive destinations in global economies where they can get that extra yield. Right now,
Mm.
the US Fed rates, the rates at which they are, the government securities are offering around 4%, right? If you look at India, the 10-year government bond yield is at 7.17%, right?
Yeah,
Combined
yeah.
with the factor that we are in a stabilized environment as of now, right?
Mm.
This continues to be, an attractive destination, right? So the rates will not undergo a rapid upheaval or, any change right now.
Mm.
We will continue to see these levels, and I think once our Indian bonds, the G6, which are permitted through the fully accessible route or FAR
Yeah.
route, wherein global investors can invest. Once that happens, when we get included in the JP Morgan's, index, number one, and number two, also there's a talks about the Bloomberg index inclusion. Once that happens, then there would be a lot of, foreign funds which would be flowing in, which
Right.
definitely is going to trigger a price increase in the government bonds, and
Mm.
correspondingly the yields will definitely undergo a decay. But
Right.
that's
So
like what I
this
foresee post inclusion of our G6 in these JP Morgan emerging market debt index and Bloomberg's local currency index.
right. So this JP Morgan inclusion is set to start from June 2024, right?
Correct.
So there have been projections that based on the flows which track funds which track the index about 300 billion or so. I mean, there have been some projections made of how much we can expect to come into India. What is your ballpark on the amount of flows that we can expect into Indian government bonds? The specific ones that are allowed under FAR.
Right, right. My expectation is that post inclusion of the Indian G6 into the JP Morgan's emerging market debt index from June 2024 onwards, right? We should see in a short span of time anywhere between 30 to $50 billion worth of inflow into the market, right? And
Mm.
that's a big amount that we will start
Mm.
seeing from July onwards, and it will keep going up till a point wherein our G6 somehow start getting muted onto the rates, right? So
Yeah,
and then we might see a slowdown in the infusion. But yeah,
right.
my take is anywhere between 30 to $50 billion of early inflow that we should see into the economy.
Are these mostly passive flows or are they active?
This has to be through the FAR route, right? Because that is the most legitimate and most widely used. I mean, individual investors from there cannot deploy into the Indian
Mm.
market, right? The regulations
Yeah.
put it that you got to have it through a fund who has
Mm.
got the permission from RBI
Right.
to infuse funds. So understandably, it has to be through these funds only in a passive way of investment that we will see.
Since only specific government bonds are under FAR, does it mean that only the yields on these will fall and the others will not actually correct to that extent?
Well, I don't see that, as a case that would be like, only the FAR approved GSEC will undergo revision in the yields.
Yeah.
Yes, they will have more revision because more capital infusion will happen in over there, right? But then we also have to understand that it would be wise for the government to also put in more GSECs into the FAR bucket, because immediately
Hmm.
they become eligible for foreign fund infusion, right?
Right.
Apart from funds getting pulled into these G6 from within the Indian economy, right? So
Right.
we would definitely see an overflow effect beyond these earmarked G6 into the overall G6 market, wherein the other G6 will also have a dampening of the yields.
Today, we are also saying in recent months this opportunity in Indian markets, especially if you look at your platform like GoldenPi and all, you're seeing shorter term bonds like 1 year, 2 year also offering very attractive yields. And almost the same yields, in fact, as the long-term bonds. So for an investor, it can be a bit of a confusing call whether you should buy these NCDs, which are very short-term, or should you really lengthen your horizon to say 4 or 5 years? I mean, what would you advise?
I wouldn't put it as an advisory, but my personal take as an individual
Yeah.
actively tracking the bond market and participating in the bond market. In that capacity, my observation will be one, it has to be purely driven by the investor's need. Because if you look at investing into NCDs, right,
Right.
it should not be just from the perspective of locking in higher yield. It also is a function of number one, what is the tenure for which I want my money to be parked over there, post which I might have certain life events where I want to use. Number one. Number two, longer the tenure of the bond, the greater is the duration risk that I'm eventually exposing myself to. So one has to make a
Yes.
very cautious judgment over there. I would say that if I, observe through the lens of an active investor into the, or somebody who is watching this market very actively, right? I would say it would be prudent for me as an investor, if I want to put in money over here, that if I'm looking for really high yields, which means I have to look at low credit rated papers of the likes of, say, A and triple B, right? Within the
Yeah. Yeah.
investment grade bonds. But if I'm
Yeah.
looking at options over there, I should not take up too much of duration risk, which means I should look at shorter tenure bonds. However,
Right.
if I am really looking for that extra level of safety cushion, right, I would look at higher rated bonds for the longer horizons, the AAA rated and some very good A rated bonds, or even the government securities for my
Yeah.
long time, and long term funds to be blocked at better rates than bank FDs. But surely the
Right.
difference where, the extra yield that I get here will not be as high as A rated and triple B rated, right? So a cautious,
Right.
balanced approach over here is what I would recommend to myself as an investor.
Right. And I think as a debt investor, you also need to match your the tenor of the bonds you buy to your own goals, right? Because for a short-term
Absolutely.
goal, you can't end up because of this duration risk that you mentioned. You
Absolutely.
cannot end up
Absolutely.
buying. Yeah. On your platform, I also see that you offer NCDs, and some of the AAA rated NCDs today offer more than 8.5% coupon and yield actually. And there are NCDs also. So how does the investor actually make this choice between FDs and NCDs?
I think, there are a couple of parameters that an investor should consider, right? First, let's look at these two choices from the criteria of safety, right?
Yeah. Yeah.
Understandably, if I'm putting money in FD, right, and I'm assuming over here the large bank FDs, right, like the PSBs, the
Yeah.
public sector banks, or the private sector banks, which are the larger ones. If I'm
Yeah.
restricting myself over there, I will get very high levels of safety, right? However, the returns I have to compromise because the levels of safety are very high, right? So I'll make anywhere between 6.5 to 6.8 percentage returns, but with very high levels of safety. Now, if
Right.
I'm an investor who is willing to take that slightly extra risk and look for that extra returns, I'll start looking at NCDs. A triple A rated NCD, right, is a fair choice to consider, right, on the safety spectrum. And 8.5% on a triple A rated versus a 6.5 on a traditional bank FD. Definitely, it's like, I mean, 2%
Yeah.
extra you're getting. That too, let's say for a 5 year investment period, it's straight 10% extra that you're making, right?
Yes. Yes.
So
Yes.
it definitely would be from that lens of, if I'm looking purely for safety, right?
Right.
I would restrict. I would rather apportion the money, a bit some amount into FD, and definitely take a short on the AAA rated NCDs or even the government securities, which are offering now 7.17%, right? Which is again more than bank FDs, right? So
Yeah.
it's important for investors to allocate funds across these. And at the same time, if I'm somebody who has got a profile of, I am really looking for yield, right? I really need that yield kicker in my portfolio. I would consider myself purely allocating into NCDs, down the rating curve. Yeah.
For retirees and other people who actually require fixed income for living expenses. Now, traditionally, they rely on FDs, whether bank FDs or NBFC FDs and the bonds. Do you think that today, with the after this 250 basis point increase in policy rates, etc., today are we at a level where such people can actually explore longer term options like 4 or 5 year options so that they have that certainty of income at this point?
Yeah, I think that's a very, very valuable question. And my take is that definitely yes, right?
Mm,
It's worth taking that shot on bonds and debentures for a duration of 4 to 5 years, right?
mm,
And however, the point of caution that should be pointed out over here is not to just restrict, picking out NCDs by just looking at the credit rating of AAA rated, right?
mm, mm,
I would recommend that when investors who are retired or are looking to create a retirement corpus before they get retired, right? They should do
mm,
a holistic assessment of not only their credit rating, but also the financials of the company, the basic financials, like is the
mm.
revenue increasing year on year for the past 3 years? Is the EBITDA
Right.
increasing over the past 3 years? And also the management, the current management quality of the company.
Mm,
These three parameters, along with the credit rating, if they are all in green, it makes sense to go ahead and park your money for a duration of, for a tenure of 4 to 5 years, to
mm.
generate that regular passive cash flow into one's, bank account.
And I guess, as you said, government securities also offer that opportunity today, right? Like you
Yeah,
can get regular income and
correct,
you can
correct.
have a safe portion of your portfolio in that.
Correct, correct. I would want to add one point over here. I think one point which gets missed out by retail investors per se when they consider government securities versus NCDs, that
Mm,
okay, government securities have safety levels which are more than bank FDs, actually
yeah,
speaking, right? In the
yeah.
real terms, right?
Mm,
And now the regulators have put in the infrastructure for investment into government securities in such a way that investors can start parking their funds as low as rupees 100 into the
mm,
secondary market G6, right? Like on a platform,
mm,
even at
yeah.
rupees 100, somebody can go ahead and buy, government
Mm,
securities. From
mm.
RBI Retail Direct, which is of RBI, people can apply for the weekly auction, right? And wherein
Right.
the minimum quantum that they have to apply for is 10,000, right? So very
10,000. Yeah.
granular level itself of
Mm,
investment,
right.
retail can start in over here. And
Right.
this becomes a great lever for greater financial inclusion also, right? So
Right.
yeah, definitely government securities are an option that retired people or people who are creating the retirement corpus should consider, because one, of the safety, second, the returns are better than bank FDs, and third, they pay on a half yearly basis, right?
Yeah.
So you are getting that interest payment which is coming into your bank account, which is great to build up that passive cash flow.
Right. So your platform enables secondary market investment in G6, is it? I was not aware of
Correct.
that.
Yes, it
Okay.
enables investments into G6 from the secondary market.
So is this available across tenors or is it a function of liquidity in certain G6? Because typically the liquidity is there in 10-year and things like that, right?
Yeah. See, what we tend to offer basically are the GSEC, which are in dematerialized form. If you
Mm,
have to buy GSEC, right, through RBI Retail Direct and others, you got to
mm.
create, the
Gilt account.
CSGL account. Yeah, the Gilt account
Mm,
needs to be created, which is an
yeah,
additional hassle, right?
right.
However, if this asset is already dematerialized, right, then it
Yeah,
becomes very easy to hold with your equity and mutual funds into your demat itself. That's
yes.
like the added advantage we have built. So we put up one or two tranches of GSEC, which are very safe ones. I mean,
Acha.
and not very long tenure either, right? It will be in the range of it changes from time to time basis what we are being able to dematerialize and put on the platform. But it varies
Mm.
anywhere between 5 to 7 years of outstanding tenure.
So what is the commission you charge on the GSEC investments? Because RBI is a commission-free platform.
There are no commissions on on
Oh,
investment into GSECs. Yeah.
so Recently, we've seen that SEBI has put out a discussion paper where it wants to basically open up access, more retail access to NCDs. So, one thing it has proposed is that the minimum ticket size for private placements of NCDs be reduced to 10,000 rupees from 1 lakh rupees or something. So, and
Correct.
there is also a proposal for fast track public issues. Now, the
Correct.
majority of NCD issuances in the Indian market are actually private placements. How do you think this proposal, if it becomes actually the regulation, what impact can it have on retail investors looking for NCDs?
Yeah, I think firstly, our market regulator for for the corporate bonds, SEBI, is doing a phenomenal job in actually putting in the right set of levers to widen and deepen the bond market so that it now becomes not a rich man's game. It no longer
Hmm.
continues to be just a rich man's game. It is available to the last retail investor for investment, right? And that is the move that you see that in earlier years, the privately placed bonds had a minimum ticket size of 10 lakh. Then,
Yeah.
come January 2023, SEBI slashed it down by 10 times. They brought it down to 1
Hmm.
lakh. And
Hmm.
further 10 times reduction is what they're proposing to 10,000. They're clear
Right.
indicators towards the fact that SEBI wants these asset classes to become available to the retail population so they're also able to enjoy the higher interest rates, higher interest returns than their bank FDs, right? So the way I see it is, like you rightly pointed it, private placement forms around 90% of the issuance in the market
Hmm.
for the debentures, and public placement is, the 10%, which is there,
Yeah.
right?
Yeah.
But if you look at the growth of the fresh issuance of debentures via public issuance, right? In fiscal year FY23, the total
Hmm.
amount that was came into the market as fresh issuance was $1.1 billion dollars. This
Hmm.
year, on the NCD IPOs, right, we are slated to hit
Hmm.
around $2.6 billion, dollars, which is like
Oh,
136% growth, right?
okay.
Similarly, on the private placement side, just to give you a bit of the stats there,
Hmm.
you know, last year, fresh issuance of privately placed papers was to the tune of around approximately $94 billion. Okay. And this year, the privately placed papers are poised to be in the range of around $100 billion, which is like 7% growth, right? As you can
Right.
see, the growth in public issuance has been phenomenal, right? But the growth in
Hmm.
private placements hasn't been that stellar because of that ticket size, the big ticket
Hmm.
size which was there, which is 1 lakh is still not to be considered retail. So the way I
Right.
see this is, when this goes down to 10,000 on the private placements,
Hmm. Hmm.
right, the differentiator for an entity trying to raise money through these two routes will become narrower, right? Number
Hmm.
one. And number two, because of this, you will see more of these corporates switching from private placement to public
Hmm.
issuance. Why? Because
Hmm.
the cost of borrowing through the public issuance is lower than you do through a private placement, though private
Oh,
placement happens to be faster, right? So there
okay.
would be a switching that I would expect to see of entities moving away from private placement to getting into public issuance.
Hmm.
That will happen. At the same time, newer players will come in, right? Firstly, they wouldn't go out with public issuance itself because there's a long set of activities which needs to be done before one does an issuance for retail. Private placements are way quicker on that front. So newer entities from newer sectors, right, will actively come in to the market to raise capital via private placement. So that's a
Right.
kind of shift in dynamics that I would expect to see. That existing
Hmm.
players will move from private placements to public issuance, and new players across other industry verticals also will start making their inroads first into the private placement area.
And public issues, they have to be compulsorily listed, is it? What is the rule?
Yeah, public issuances definitely they have to be
Hmm.
listed because retail would subscribe to it. So as per
Yeah.
SEBI norms, they have to be listed either in BSE or
Right.
NSE or both.
That will mean better ongoing disclosures of financials, etc. also,
Exactly,
right?
exactly.
Because, yeah, yeah.
Correct.
So, final question. Recently, we are hearing a lot about these banks really scrambling for CASA and this credit deposit ratio being very tight, etc. So, do you see bank FD rates going up and generally FD rates going up from here, or do you think just like market interest rates, they've also sort of topped out?
See, at the end of the day, banks are now sitting on a large volume of undeployed capital, right? And for them to be able to deploy the capital, right, it is essential that they are being able to do it through the right avenues, through with which they are able to make upliftment in their margins, right? I don't foresee that the banks would increase the interest rates significantly because at the end of the day, a bank trying to compete with a triple A rated NCD that's offering 8.5, right? Uh, that would be like immediate hit on their
Yeah.
on their top line,
Net interest
right?
margin also.
Yeah,
Yeah.
yeah, correct. The NIMs would have tremendous contraction. So
Yeah.
what I foresee, is basically the banks would rather try out alternate avenues of these fund deployment through the NBFCs. So what happens is,
Right.
rather than taking in more deposits and trying to build up for the CASA, right? At the end of the day, for the top line to be intact or even grow further, they're getting more and more into this co-lending model that RBI has put in, wherein
Yeah.
the bank can put in 80% of the capital and the NBFC can put in, I think, 20% of the capital. The 80-20 ratio, wherein the NIMs are higher for them, number one. Number two, the entire due diligence first is being done by the NBFC, and the better
Right.
quality NBFC a bank is able to tie with, the safer is the deployment of capital without much overhead on them, right? So that's a business story that I'm seeing is getting unfolded across this entire, debt market.
Thanks a lot, Abhijit. It was a very insightful and useful conversation for fixed income investors.
It was a pleasure speaking with you, Aarti. Thank you so much.